Welcome to the deep dive. Today we are wrestling with, well, what is maybe the greatest paradox in modern finance? GameStop Corp, GME.
It really is a paradox.
For years, the headlines have all been screaming dying mall retailer, but if you actually look past the noise, the balance sheet, it just whispers financial fortress.
It screams it, really.
So how can a $10.19 billion market cap company that is deliberately contracting, they're closing stores, they're getting out of markets like Canada and France, how can it be valued only a tiny bit above the massive pile of cash it's sitting on?
It's a fantastic question. The market seems to be pricing the entire retail business, the brand, the real estate, the inventory, everything at nearly zero.
Or even a negative value. It's bizarre. The conclusion we're working toward today, it's not just about valuation, it's about governance. Has Ryan Cohen really transformed GME into this unmissable, deep value play? A kind of sovereign investment vehicle, or is the operational risk just too high for that cash to ever be deployed effectively?
That is the essential conflict.
Right.
And it demands an analysis that fuses, the classic principles of Benjamin Graham's safety of principle with the realities of a 21st century market.
Right.
Our analysis today is current as of Friday, November 28, 2025. The stock closed at $22.75.
Right.
We have to figure out if GME is just delaying its demise or if it's genuinely become, a Berkshire Hathaway for the digital age. We have to be rigorous about this, evaluate that financial safety net against modern risks like the $500 million bet on Bitcoin and that massive geopolitical storm brewing with the 2025 tariffs.
So our mission today is to unpack all the dense source material you, the astute learner, have shared. We want to distill exactly what this cash-rich paradox means for anyone looking for those asymmetric risk-reward profiles. We're starting at the foundation, the business itself. Then we'll get into management and the financials that underpin this whole story. Part 1, chapters 1 to 3. Business management and financials. Chapter 1, business understanding.
Chapter 1, business understanding.
Okay, let's unpack this. If we try to look at GameStop in 2025 the old way, it's just a retailer, it just doesn't work. We fail. The source material is really clear that GME is now what they call a bifurcated entity.
It is. You have to stop viewing it as a single business. It's fundamental to the whole thesis.
So what are these two distinct models that are operating in parallel?
On one hand, you have the legacy retail operations. This is what everyone thinks of. The physical stores, the malls, the part Wall Street just obsesses over.
And that's the part that's shrinking.
Exactly. It's undergoing a severe and, crucially, an intentional contraction. Management is systematically shedding what they call empty calories. They've closed hundreds of stores that weren't performing, and they've exited low-margin international markets. Canada, France, gone.
So while that part still generates most of the top-line revenue and the number you see in the headlines, its real job is different now.
Its strategic function is optimization and cash flow generation. It's not about growth anymore. But its core, its non-replicable value proposition, that remains the buy-sell-trade ecosystem.
And why is that buy-sell trade cycle so critical right now, especially as we head into the end of 2025?
It's all about the macroeconomic environment. Look, we're in a high inflation cycle. For lower to middle income families, the ability to trade in old games, old consoles, that can offset the cost of new hardware by, 30, sometimes 50%.
Which makes a huge difference on a big ticket item.
A huge difference. It makes something like the new Nintendo Switch 2 affordable. It's a mechanism for affordability that purely digital competitors like Amazon or Microsoft, they just can't replicate it. It's a critical value prop when every dollar counts.
Okay, so that's one side. And then on the complete opposite end of the business, you have the new engine, the thing that really justifies this entire conversation, the investment in Treasury operations.
Precisely. And this is the part that functions like a sophisticated internal hedge fund or a holding company. And it's overseen directly by the CEO.
Yeah.
The sheer magnitude of the war chest, you just can't overstate it. We're talking about approximately $8.7 billion in cash and equivalents as of Q2 2025.
$8.7 billion.
It's the core of the financial fortress. And that capital is deployed primarily into high-quality interest-bearing securities. In this high-rate environment, that's generating hundreds of millions in guaranteed low-risk income.
And then, of course, there's the elephant in the room.
The Bitcoin. The notable strategic allocation to Bitcoin, which now exceeds $500 million. This dual structure means GME's risk profile is now defined as much by interest rates and crypto as it is by holiday retail sales.
Okay, let's focus back on the retail side's future for a moment. The evolving product mix. It shows a really heavy reliance on hardware and accessories. They make up, what, 54.9% of sales? And the timing here seems critical.
The timing is serendipitous. I mean, that revenue anchor got a massive, guaranteed injection of life this year from the Nintendo Switch 2 launch, which was back on June 5, 2025.
And a new console supercycle, that's not a one-off event, it has legs.
It lasts 5 to 7 years, typically. That guarantees significant foot traffic and transactional volume for years to come. Our sources are confirming the Switch 2 was outselling the PlayStation 5 and Xbox Series X combined in the fall.
Wow.
And that phenomenon, it doesn't just drive traffic for the console. It drives traffic for the higher margin attached products.
Which would be the accessories.
Exactly.
Yeah.
Accessories, controllers, headsets, VR units like the MetaQuest 3, they provide higher attach rates and, crucially, the higher gross margins that the company needs to hit its profitability targets. Hardware is the bait, the accessories are the profit.
But the weakness that's always been there remains software. It's 26.3% of sales, and GameStop is fighting this unstoppable shift to digital distribution. How are they adapting their software strategy?
Well, they can't win the war against digitalization, so they're pivoting to a niche appeal, with subscription models like Xbox Game Pass dominating the market. The physical disc is becoming obsolete for a lot of people.
So what's the plan?
GameStop's new strategy is to focus on the enthusiast, the collector. They're securing inventory of launch day physical editions, exclusive collector's sets, bundles that still appeal to a committed minority who, they value ownership over access. They're serving the gamer who wants a physical artifact, not just a digital license.
And that ties directly into their big strategic growth area, collectibles, at 18.8% of sales. This category is growing fast, and it's often called recession-resistant, part of that kid-adult economy.
This is where you see the stores being strategically transformed. The source material talks about a very significant, very aggressive partnership with PSA Professional Sports Authenticator.
One of the biggest names in grading services.
Exactly. By offering in-store trading card grading, GameStop is solving a huge pain point for serious collectors, the need for secure, in-person handling of high-value cards. This move, it fundamentally transforms the stores from just sales outlets into community and service hubs.
Which boosts foot traffic for reasons completely unrelated to video games.
Right. And most importantly, it generates substantially higher margins than software.
Let's pivot back to the investment side, to the market position and value proposition. I have to challenge this. If the market cap is $10.19 billion and the net cash is $8.49 billion, that leaves about $1.49 billion for the entire operational business. Why is the market so skeptical? Why is it pricing a profitable retail arm so incredibly low?
That is the crux of the market anomaly. Wall Street is discounting the retail operation almost completely because they just assume its inevitable demise. They're saying the value of this brand is rapidly approaching zero.
But for a certain type of investor.
For the astute investor, this creates an asymmetric upside. The massive cash balance at $8.7 billion acts as a huge tangible floor for the stock price. If the stock drops to, say, $20, it's literally trading at its cash value per share.
So you get free exposure to any upside.
Exactly. You get free exposure to a retail turnaround driven by the Switch 2, plus free exposure to massive potential gains if Bitcoin continues its run toward, who knows, $150,000 or $200,000. It's a classic deep value situation hiding behind a meme stock narrative.
But the safety of that cash is being tested by some pretty major key industry headwinds. Let's talk about the most acute, maybe even existential threat on the horizon, the tariff shock of 2025.
This is the external geopolitical risk that keeps executives up at night. The Trump 2.0 administration has been very aggressive with trade protectionism. We're talking a baseline 10-20% tariff on most imports, with even higher tariff on Chinese goods.
And that's where all the consoles are made.
The vast majority. The critical components for the Switch 2, all the accessories, it all comes from China. So this is a critical threat to the supply chain.
What are the practical implications? A 30 or 40% hike in the cost of goods sold.
Exactly. And this isn't just a margin squeeze. It's a supply chain destabilization event. It threatens huge disruptions, potentially delaying the Switch 2 rollout in the crucial North American holiday quarter.
And worse, it causes demand destruction.
Of course. If the price of a Switch 2 jumps from a consumer-friendly $450 to a painful $600 or $650 because of tariffs, sales volumes will just collapse. This is what CEO Ryan Cohen was sarcastically referencing when he talked about the risk of a $10,000 iPhone. He's trying to shock the market into realizing the severity of this risk.
Despite those headwinds, GameStop must have some competitive advantages, some moats to survive. What are they?
We can identify three pretty robust moats. First, the physical network. Even though it's shrinking, that network is crucial for the reverse logistics of the trade-in ecosystem. No digital-only competitor can feasibly manage the authentication, intake, and resale of millions of physical used assets.
The dependency.
Right. Second, the capital fortress. $8.7 billion in cash ensures survival through any recession or trade war. It gives them time and power for strategic acquisitions when competitors are weak.
And the third?
The third is the cultural moat. The company has a unique loyalty and just huge mind share among a massive dedicated base of retail investors. This is an intangible asset, but it translates into brand resilience and even the market dynamics we'll get into later.
It's clear the cash position just overrides everything else here. With a war chest that size, the analysis quickly shifts from the business to the people holding the purse strings. Chapter 2, Management Evaluation.
Chapter 2, Management Evaluation.
So we shift our focus now entirely to Ryan Cohen. He's the CEO, the chairman, the largest individual shareholder. His history at Chewy.com is well known. But his philosophy at GameStop seems to be all about efficiency and capital preservation, not growth. Why the shift?
Because the starting conditions were completely different. At Chewy, he was building from the ground up. At GameStop, he was rescuing a sinking ship. His focus on capital preservation, not reckless growth, that reflects his mandate.
He inherited a company on brink.
Near insolvency in 2021. His crisis response was a masterclass in opportunistic finance. He strategically used that intense stock volatility, the meme stock, squeezed to issue equity, and raised billions of dollars when the stock was, frankly, vastly overvalued.
Which is the definition of financial prudence, selling overvalued stock, even if the situation was chaotic.
Absolutely. That one decision was the single most important factor in securing the company's survival and building that $8.7 billion cash pile. Now, fast forward to 2025, his response is what you'd call prudent contraction.
Shrinking to save it.
Right. He's aggressively cutting costs, shedding unprofitable segments, and making sure the company stays GAAP profitable even as revenue shrinks. His comment about the $10,000 iPhone isn't just a joke. It shows he fully understands the macroeconomic threats, and he's positioning the company to survive them.
Let's talk about the constant critique from Wall Street. Governance and alignment. Analysts always complain about his lack of communication. If he wants the stock to trade at its intrinsic value of, say, $35, why is he so opaque?
His communication style is notoriously opaque. GameStop abandoned earnings calls. They refused to provide forward guidance. And this deliberately frustrates the, let's call them quarterly renters, the analysts focused on short-term movements.
But it aligns with a long-term owner philosophy.
Perfectly. It's very similar to Warren Buffett's approach at Berkshire. It prevents competitors from knowing your long-term plans, and it frees management from the pressure of hitting arbitrary quarterly targets.
What about personal alignment? Does he have skin in the game?
His alignment is almost absolute. He takes no cash salary. His entire compensation is tied solely to the increase in shareholder value. That creates an unparalleled incentive structure. He only makes money if the stock price goes up, so he's incentivized to make sure it reflects that intrinsic value.
Which brings us to the most speculative but maybe highest potential part of the strategy, capital allocation. When you have $8.7 billion, what do you do with it? What is the current strategy?
The current strategy is preservation and optionality. They're investing very little in the core retail business, only on high-return things like the collectibles expansion. They're avoiding big CapEx. The real focus is M&A optionality.
So they're sitting on the cash waiting.
Waiting for the macroeconomic volatility, maybe even the tariffs, to create distressed asset prices. They're waiting for a bargain.
What kind of profiles are they looking at? Vertical integration, or are they looking to diversify away from gaming?
Our sources suggest they're evaluating both. If Cohen wanted vertical integration, he might target a medium-sized game publisher to get better margins on digital content. If he opts for diversification, the focus is likely on the broader tech or consumer space, where he can acquire a profitable e-commerce platform and use his operational expertise. The delay isn't indecision, it's patience.
But if the stock is trading below its intrinsic value right now, why haven't we seen a massive share buyback program?
Well, historically, GME was a net issuer during the squeeze, which was the right move. But now, if the stock gets close to its book value, which we estimate is around $20 per share in cash, a multi-billion-dollar buyback becomes a huge possibility.
They have the option.
They have the explicit optionality to deploy billions to shrink the share count, which would instantly boost EPS and help the market realize that intrinsic value. They're just waiting for the market to undervalue it aggressively enough to make a buyback the best use of capital.
Okay, let's tackle the ROIC nuance. Traditional return on invested capital makes GameStop look pretty stagnant. Why is that analysis misleading in this retail plus treasury model?
It's misleading because traditional ROIC focuses almost exclusively on the operating retail margins, which are recovering, but slowly. The total return is defined by the treasury management. In this high-interest rate environment, that $8.7 billion cash pile is generating a baseline guaranteed return of 4% to 5% a year.
Can we put a dollar figure on that? How much non-operating income are we actually talking about?
Conservatively, at 4.5% interest, that $8.7 billion generates about $391.5 million in annual interest income. That is a significant stream of income that effectively subsidizes the retail turnaround.
And this is essential context.
Absolutely. When Q2 2025 reported a GAAP net income of $168.6 million, a huge chunk of that, we estimate over half, came directly from interest and investment gains. It validates the retail plus treasury model and shows how the cash is generating profit even while the retail arm is being optimized.
That distinction is vital. It's not just operational profitability, it's financial engineering driven by prudence.
Yeah.
Chapter 3.
Financial health.
Chapter 3. Financial health.
Okay, diving into the financials. The revenue story is clearly one of managed decline. Revenue is down from about $6 billion in FY 2022 to an estimated $5.27 billion in FY 2024. On a standard retail income statement, that looks awful. If you were grading a typical retailer, yes, this would be catastrophic. But we see this decline as a feature, not a bug. It's the direct result of shedding those empty calories, unprofitable stores, entire international markets. Management is prioritizing profitability over growth at any cost.
So Q2 net sales were $972.2 million, but the real story is in the margins.
Exactly. The story is the margin expansion. This is the success story. The gross margin is expanding significantly to about 30.06%. This is fueled directly by that shift in product mixless, low-margin new consoles, more high-margin collectibles, and pre-owned goods.
And crucially, the operating margin is now positive.
Yes. Q2 2025 saw operating income of $66.4 million. That's a massive swing from prior year losses. It's definitive proof that the disciplined cost-cutting SG&A was slashed from $270.8 million to $218.8 million in Q2 alone, is outpacing the revenue decline.
And the net margin at about 17.3% is heavily bolstered by that treasury income we just talked about. This fiscal discipline has also meant GameStop is now free cash flow positive.
Yes, the extreme frugality mandate, disciplined inventory management, low capex. It all means the company is no longer burning cash. After years of bleeding, that $8.7 billion war chest is now actively being padded by positive FCF, reinforcing the fortress.
The financial stability section, this gives the clearest picture of safety in the whole analysis. Let's talk about that fortress balance sheet.
It is pristine. The debt-to-equity ratio is effectively zero. They have no long-term corporate bond debt. This freedom from interest payments is a huge advantage, especially in a high-rate environment where debt is crushing competitors.
And the current ratio?
It's a staggering 8.05. For context, a healthy retailer aims for 1.5 to 2.0, having 8 times the liquid assets you need to cover near-term obligations. It's an almost excessive safety margin. It shows an unparalleled commitment to preservation.
Okay, now for the part where we challenge the Wall Street narrative, valuation paradox. If you just look at the PE ratio of 73x and compare it to Best Buy at 12x GME, it looks impossibly expensive. This is the PE trap.
It is. It's the trap designed to scare away traditional analysts. The PE ratio is useless here because the operating earnings are still modest, but the share price is underpinned by $8.7 billion in cash. You have to look at the enterprise value, EV, to see the true cost.
Let's break down the EV calculation in detail because this is the single most important metric for you to understand.
It's simple accounting. Market cap is $10.19 billion. You subtract the $8.7 billion in cash. That leaves a remarkably low enterprise value of only $1.49 billion. That number, that's what the market is actually pricing the entire operational retail business at.
So if the business is only valued at $1.49 billion, what does the EBITDA multiple tell us about how cheap it is?
When you take that EV and compare it to the estimated annual EBITDA, which we conservatively put between $250 and $300 million, the resulting EV/EBITDA multiple is only about 5x to 6x.
Which is incredibly low.
It's the key insight. Most healthy retailers trade between 10x and 15x. Even distressed retailers trade higher than 6x. The market is pricing the operational GameStop business, which is profitable and has the Switch 2 tailwind, at a deep, deep discount.
Okay, let's move to the intrinsic value based on the DCF model in our source material. It estimated the value at $35.13 per share. That's a 54% upside. I have to challenge the assumptions here. The source material uses a near-term growth of 28.6% and an ultra-low beta of 0.25. How do you justify those numbers? They sound wildly optimistic.
You're right to challenge them. Let's tackle the 28.6% growth first. This isn't purely retail growth. We estimate retail operations with the Switch 2 contribute maybe 5% to 7% growth. The rest, the other 21% to 23%, that comes from the non-operating Treasury income.
From the interest on the cash pile.
Exactly. Since the $8.7 billion is earning nearly $400 million a year, and that flows straight to the bottom line, it dramatically lifts the total net income, justifying the high growth rate in the DCF. It's income diversification, not retail resurgence.
Okay, that clarifies the growth. Now, the ultra-low beta of 0.25. Beta measures a stock's correlation to the market. A normal stock is around 1.2. A 0.25 beta suggests GME is almost completely uncorrelated, trading on its own news. That's an aggressive assumption that seriously juices the DCF value. How do you justify that?
This is where modern market structure comes in. The low beta is justified by two unique structural factors. First, that massive cash floor inherently limits downside risk. It decouples it from market crashes. Second, and more profoundly, is the impact of direct registration, DRS, and the high short interest.
So because so much of the float is locked away or shorted?
The supply and demand dynamics are driven almost entirely by these internal technical constraints and retail sentiment, not the broader economy. When the available supply is that constrained, price movement is dictated by internal flows, not external factors. The DCF model uses that low beta because the stock trades on Cohen news and short covering pressure, not GDP reports.
So it's a structural valuation, not a traditional fundamental one.
Exactly. It accounts for the financial safety net and the unique volatility setup. The conclusion is clear. The $35.13 per share estimate is based on the assumption the market will eventually recognize the inherent safety of the fortress balance sheet.
Time for a necessary transition point before we dive into the market dynamics, ownership, and risk factors. If you are finding this deep dive valuable, do us a favor. Like and subscribe to Stock Analytics AI. And for those seeking even more targeted intelligence, our membership tier provides immediate access. For $4.99 a month, you get over 500 deep dive videos on all S&P 500 stocks, with the NASDAQ 100 coming next, plus members-only requested deep dives.
We've established the financial safety net, the debt-free status, and the operational turnaround. Now we have to shift our focus to the volatile environment where this cash-rich company meets the structural anomalies of the modern market.
Part 2, chapters 4 to 7. Market sentiment, ownership, risk, and final conclusion.
Chapter 4, Market Sentiment.
Chapter 4, market sentiment.
The market sentiment for GME, it remains just severely polarized. You see this huge chasm between Wall Street skepticism and the quant signals. How are traditional analysts reacting to the Q2 profitability and that growing cash pile?
They're reacting with caution, with criticism, often refusing to update their models. Firms like Wedbush, they're maintaining their bearish underperform rating, sticking to a low $13.50 target, but their critique has shifted.
It's not just about the retail decline anymore.
No. Now they focus on governance risk. They explicitly cite the $500 million Bitcoin allocation as a Bitcoin gamble, arguing the capital is being misallocated into volatile non-core assets instead of being returned to shareholders.
That is a fair governance critique, and we need to address that Bitcoin allocation. Cohen chose that size for a reason. It's a strategic hedge against fiat depreciation, but it poses huge accounting challenges. Unlike MicroStrategy, GameStop has to account for this under strict GAAP impairment rules.
Meaning if the price of Bitcoin falls.
They have to record a non-cash impairment charge, which directly hits GAAP profitability and validates that analyst critique about governance risk.
So the bullish quantitative signal must just be ignoring that risk entirely.
They are. Independent research, especially from quant models like Simply Walsing, they consistently flag the stock as undervalued because their models prioritize the cash flows, the low EV/EBITDA, the debt-free balance sheet. They effectively filter out the noise of the retail decline and the governance critiques.
Looking at the media and social sentiment, the tone is just as polarized. The traditional financial press still loves the meme stock nostalgia, but the retail community, the ape movement, seems to have evolved.
The evolution is fascinating. The traditional press is slow to acknowledge fundamental improvement. But retail sentiment is overwhelmingly positive because they're focused on gap profitability and capital preservation. That validates their whole long-term thesis.
And the recent surge in Bitcoin.
The recent massive surge in Bitcoin topping $120,000, that was a huge vindication for Cohen's Treasury strategy. It turned a perceived gamble into a highly profitable investment gain, which just further boosted sentiment.
This loyalty feeds directly into the volatile technical setup, the short interest. This is a persistent structural anomaly we have to analyze.
It is the ultimate structural driver of volatility. Despite the profitability, despite the cash safety net, short interest remains stubbornly high. We're talking 16.90% of the float, or 69 million shares. Hedge funds still believe the retail business is doomed.
But the real danger metric for them is the days to cover.
A days to cover, or DTC, currently stands at an alarming 14.25 days.
Remind the listener why 14.25 days to cover is such a potent technical powder keg.
A DTC ratio above 10 is considered extremely high. It means if short sellers suddenly needed to cover their positions, say a huge M&A announcement was made, it would take them over 2 weeks of normal trading volume to buy back the stock they owe.
So any good news could trigger a squeeze.
A violent, reflexive short squeeze. The panicked demand from covering shorts would just far exceed the limited supply available. This structural setup is what provides that asymmetric upside.
And leading into the crucial Q3 earnings report, the moving averages suggest some bullish momentum.
Yes. The price is trading above the 50-day moving average, signaling short-term strength. It suggests investors are positioning for a continuation of the profitability streak, hoping Treasury income and the Switch 2 cycle offset any retail noise.
Chapter 5, Ownership Structure.
Chapter 5, Ownership Structure.
Let's examine institutional holdings, which are at about 40.43%. You mentioned this is mostly passive necessity. Why aren't active value funds embracing this cash-rich, deep value play?
They're generally avoiding it because of that meme stock volatility and the governance noise. The vast majority of institutional holdings are passive index funds, Vanguard, BlackRock, who are forced to hold GME because it's in the Russell 2000 and the S&P Midcap 400. They're stable, but not conviction holders.
But there are some active traders.
We do see sophisticated quant funds, like LMR Partners and Renaissance Technologies, explicitly trading the volatility, the technical setup, and the short-term price movements. That confirms its status as a high-frequency trading asset.
Given that skepticism, the insider alignment becomes the most important qualitative signal. Ryan Cohen is the largest individual shareholder.
His alignment is the clearest vote of confidence you can get. Cohen holds 8.4% of the shares, 37.3 million shares. But the specific crucial detail is what he did in April 2025. He purchased an additional 500,000 shares on the open market at $21.55.
Investing almost $11 million of his own money.
Exactly. I have to challenge this, though. If he's sitting on $8.7 billion in cash, why only 500,000 shares? Is that a symbolic gesture or a genuine belief?
It's both symbolic and genuine. While it's small compared to his total holding, it's a massive commitment of personal cash. The investing adage holds true. Insiders sell for many reasons, but they buy for only one. They believe the price will go up. Cohen's purchase is concrete evidence he views the stock as significantly undervalued.
It minimizes the key man risk.
It does. His personal financial success is absolutely intertwined with the company's valuation.
Finally, we must spend serious time on the structural constraint, direct registration, DRS. This is a unique movement specific to GME, and it fundamentally impacts the supply of shares.
The DRS phenomenon is a deep dive in itself. Shareholders voluntarily remove their shares from the DTC, the Depository Trust Company, and register them directly with the company's transfer agent Computershare.
By doing this, those shares are functionally removed from the tradable and, critically, the lendable pool used by institutional short sellers.
What is the resulting impact on the float and the risk profile?
The impact is structural illiquidity. It mathematically reinforces that 0.25 beta and the high DTC ratio. Sure. Approximately 69.5 million shares, 16% of the total float, are locked away via DRS.
So you combine those locked shares with insider holdings and the passive ETFs.
And the free float available for trading and shorting becomes severely constrained. When the float shrinks, any marginal increase in demand has an outsized impact on the price. It exacerbates volatility to the upside and makes that technical short squeeze setup significantly more potent.
Chapter 6, Risk Assessment.
Chapter 6, Risk Assessment.
Let's systematically review the internal health with a SWOT analysis. On the strength side, we have the $8.7 billion balance sheet fortress and that proven ability to cut costs faster than revenue declines.
Correct. But the weaknesses are profound and persistent. GameStop is fighting the secular decline of physical media, a headwind no CEO can fully reverse. There's also unavoidable keyman risk. The value prop is so heavily reliant on Ryan Cohen's leadership.
And they still have lease liabilities.
Significant store lease liabilities long-term, expensive obligations that are difficult and costly to break.
On the opportunities side, we have three massive potential tailwinds. The guaranteed foot traffic from the Switch 2 supercycle, the potential for huge Treasury gains if Bitcoin appreciation continues, and most importantly, the enormous acquisition optionality from the cash pile.
But we have to return to the most acute external risk, the geopolitical threat, the 2025 tariff wall. This is the risk that could functionally wipe out the margins on hardware and accessories, regardless of Cohen's operational genius.
Let's dive deeper into this risk. We know the tariffs could raise the cost of goods sold by 30–40%. Detail the practical logistical challenges this creates.
Logistically, it's massive upheaval. Suppliers in China will demand higher prices or require sourcing to shift. This creates complexity. They have to explore supplier diversification, looking at manufacturing bases in tariff-immune regions like Vietnam or Mexico. But quickly shifting the supply chain for specialized electronics is immensely difficult and costly.
So the tariffs don't just increase costs.
They break established, optimized relationships and potentially delay critical products. It's a supply-side shock that leads directly to demand destruction if consumer prices spike too high.
So how does GameStop, better than a pure-play electronics retailer, navigate this? You mentioned the mitigation strategy of the pre-owned market.
This is GameStop's defensive moat against tariffs. They're uniquely positioned because of their heavy focus on the pre-owned ecosystem. Its inventory of millions of used games and consoles is, crucially, a tariff-immune stockpile. The items are already in the country. They're not subject to new import duties.
So if tariffs push the price of a new console up by $150, the demand for and the value of GME's used console inventory skyrockets.
Precisely. The relative value proposition of the pre-owned market becomes much more attractive to consumers. So even if tariffs crush new hardware margins, GME's core trade-in business, which has higher margins anyway, remains resilient and could even see a demand boom.
And finally, on the macroeconomic hedging front, that cash pile helps offset the inflationary pressure hurting their core customer.
That is the core benefit of the Treasury model. While inflation hurts the consumer's discretionary income, that $8.7 billion cash balance earns higher interest income in this high-rate environment. The interest generated by the Treasury acts as an automatic internal hedge, ensuring financial safety no matter what.
Chapter 7.
Conclusion.
Chapter 7. Conclusion.
Let's synthesize everything and provide a balanced summary of the bull versus bear case.
The bull case rests firmly on the deep value proposition. You're effectively buying $1 of liquid assets for about $1.15, meaning the entire retail business is priced almost for free. The company is fundamentally safe, debt-free, FCF positive, GAAP profitable.
And you get exposure to the hedge fund model and the technical squeeze potential?
Exactly. The short squeeze potential is amplified by that 14.25 days to cover and the structural illiquidity from DRS.
Conversely, the bear case is rooted in obsolescence and governance fears. The bear argument is that the retail business is still a melting ice cube, with revenue continuing to shrink. They fear capital misallocation, that the Bitcoin investment is a gamble that could lead to huge impairment charges, and they believe the severe tariff exposure is an existential threat to the accessory business.
Let's restate the final valuation summary based on our comprehensive analysis.
The estimated intrinsic value range remains robust, $30 to $35.13 per share. The neutral outlook confirms that the market is currently pricing GME at $22.75 as a generic dying retailer, entirely ignoring the cash fortress and the optimized profitability.
Meaning the downside risk is strictly limited, while the upside potential is fundamentally open-ended.
Precisely. The downside is capped by that cash floor, around $20 per share. The upside is open-ended, driven by the Switch 2, crypto appreciation, or the inevitable structurally amplified short squeeze. It is one of the most asymmetric risk-reward profiles out there today.
So what does this all mean for you, the astute learner? The question is no longer about GameStop survival. That's been secured by the $8.7 billion war chest. The question is about deployment. To realize that $35 intrinsic value, Ryan Cohen has to deploy the cash. The question for the market now is, which specific acquisition, a tech company, a game studio, a collectibles marketplace, will he choose to prove his critics wrong and complete this transformation? Keep an eye on the Q3 earnings report for specific evidence of that PSA partnership impacting the collectibles margin. That will be your first signal that the turnaround is working. We hope this deep dive gave you the insights you needed to understand this unique stock. Don't forget to like and subscribe to Stock Analytics AI.
And please remember that this detailed analysis was generated by an AI system based on the provided research for educational purposes only and should not be considered financial advice. You must conduct your own extensive research or consult with a qualified financial advisor before making any investment decisions.